bullish impulse, price retraces back to the order block. This is where we wait for signs of confirmation. As price enters the demand zone, we observe how the market reacts to this level. As price retests the order block, we look for confirmation signals such as rejection wicks showing buying pressure, bullish candlestick patterns like engulfing candles, a minor structure shift indicating renewed buying interest. Once price shows confirmation and starts moving upward, this is the entry trigger for a long trade, aligning with institutional buying momentum. Now, let's examine a bearish order block which follows the same principles, just in the opposite direction. In this case, the market was in a strong uptrend, forming higher highs and higher lows. However, upon reaching a significant resistance level, price struggled to push higher, eventually reversing sharply and breaking the previous higher low, signaling a bearish shift. When price fails to continue higher and instead breaks below a recent higher low, it confirms a bearish market structure shift. This indicates that smart money has begun shorting the market. The starting point of this strong downward move is the bearish order block. This is usually a large bearish candle before price drops sharply, marking the area where institutions likely entered short positions. As price falls rapidly, it often leaves behind fair value gaps, areas of inefficiency that indicate strong institutional activity. The market will often return to this zone before continuing downward. After the initial sell-off, price retraces back toward the bearish order block. This is where you watch for the supply zone to be tested, looking for a possible short opportunity. When price re-enters the bearish order block, watch for three key signals: rejection wicks, which indicate selling pressure, bearish candlestick patterns like engulfing formations, and a short-term structure shift, confirming continued bearish momentum. When all these signals align, it's your confirmation to enter a sell trade with the expectation that price will continue moving lower as the bearish trend resumes. As I always say, top-down analysis is crucial. This is the trade plan, but you still need to analyze the higher time frames to make sure your setup aligns with the overall market direction. Trading against the higher time frame trend lowers your chances of success, so always confirm the bias before you execute your trade. Now, let's move on to the third strategy, which is the RSI divergence strategy. RSI divergence is a powerful technical analysis tool that helps you identify potential market reversals by comparing price movements with the relative strength index. RSI divergence happens when price and the RSI move in opposite directions. This signals that the current trend might be losing strength and a reversal could be coming. For example, if price keeps rising but the RSI starts to fall, it often means the uptrend is weakening. Similarly, if the price is falling but the RSI begins to rise, it may indicate that the downtrend is losing strength. You can use two main types of RSI divergence to analyze potential market movements: bullish and bearish divergence. A bullish divergence occurs when price makes lower lows while the RSI forms higher lows. This usually happens when the RSI is below 30, a level that indicates the asset is oversold. Even though price keeps falling, the RSI suggests that selling pressure is weakening. This could be a sign that a bullish reversal is on the way. Bullish divergences are often strong signals that the trend may soon shift to the upside. In a bearish divergence, the price forms higher highs while the RSI makes lower highs, often around 70 or above, signaling that the asset is overbought. Although the price continues to climb, the RSI indicates that buying pressure is weakening. This is usually a sign that the uptrend is losing momentum, increasing the likelihood of a downward reversal. Now, let's apply this strategy to identify high-probability trade setups. In this example, the market is in an uptrend, forming a higher high while the RSI prints a lower high, indicating divergence. However, divergence alone is not enough to confirm a trade. We need additional confluence factors to strengthen our entry decision. As you can see, the market broke above this resistance level, yet we still have divergence, which signals a potential reversal. This means we need further confirmation before taking a trade. Now, look at what happened next. The market initially broke above the resistance, but then closed back below it, creating a clear liquidity sweep. This liquidity grab validates the divergence, providing an additional confluence factor to confirm the reversal. Before entering the trade, it's essential to check the higher time frame to ensure it aligns with the trading time frame. If the higher time frame is in a downtrend or showing signs of weakness, you can place a sell order at the close of the candle that closed below the resistance level. Set your stop loss above this candle and target the next key level. As expected, the market moved toward the target. Look at another example. As you can see, the market is trending downward while the RSI is in the overbought zone. The market makes a lower move while the RSI moves higher, indicating another clear divergence. Now, we have another confluence factor that strengthens our entry decision, a liquidity sweep. Here, the market triggers stop-loss orders placed by buyers, creating a false breakout before closing back above the level. This confirms a liquidity sweep, further validating our trade setup. At this stage, we have both RSI divergence and a liquidity sweep. The next step is to check if the higher time frame aligns with the setup. If you want a deeper understanding of top-down analysis, be sure to watch our dedicated video on the topic. Once all conditions are met, you enter the trade at the close of this candle, set a stop loss below the liquidity sweep, and aim for the next key level. As you can see, the market moved to the target as expected. Now you understand how smart money moves, so start using these strategies to trade with them, not against them.